Hello, this is Monica Sawyer. Welcome to Real Estate Investing for Women, where we focus on all aspects of real estate investing, including strategies, mindset, emotional mastery, money smarts, and so much more to ensure your success. If you'd like to learn my personal favorite investing strategy, just go to blissfulinvestor.com. You can also listen to this episode on the Real Estate Investing for Women podcast on iTunes. Now, let's welcome our guest. Today, I am so excited to welcome to our show Angela Alvig. Angela is a CPA with nearly 20 years experience who works with successful individuals and families as their family CFO. Angela and her team manage the details of their clients' financial lives so that they can focus on other priorities in their life. Angela not only helps her clients manage their real estate portfolios and other complex assets that they own, she also is a real estate investor herself. Angela founded her firm Simplify Wealth in 2015 and leads a team of 6 providing simple, authentic solutions to their clients to solve their financial pain points and help them meet their goals. Angela is a passionate, results-oriented financial professional with a unique combination of technical expertise, interpersonal skills, and a proactive, make things happen approach. The reason that I'm having Angela on the show today is so many of you have asked for information about taxes and all the tax implications with real estate as we're heading into tax season. So Angela's going to talk to us a little bit about that today. Welcome to the show, Angela. How are you?
Oh, I'm great. Hi, Monica. Thanks so much for having me.
Yeah, this is so exciting. And thank you for coming on earlier so that we could sort of meet the needs of my audience today.
Wonderful.
Yeah.
I look forward to it.
Yeah. So, let's start with the first question you sent me, which is sort of, know what you own, real estate and otherwise. Let's talk about that.
Sure. So when I work with my clients as their personal CFO, this is really the first thing that we tackle. And I find that even very successful individuals, sure, they know in their head what they own. They're smart people. But when I say, oh, do you own that piece of real estate directly or through an LLC? And they're like, oh, actually, I'm not really sure. And so we, look at the paperwork, document what they really own and how. And it's assets, it's liabilities, but it's also other things like, life insurance, health insurance, property insurance. I think the property insurance is probably the biggest thing that I see as an issue when I look at people's whole picture. Either they have become more successful over time and they've outgrown maybe the level of insurance that they have, or now that they are real estate investors, they just really need to reevaluate that both their property is insured, but also their personal liability, right? Having the proper liability coverage. So, I think just putting it down on paper, I think something as simple as an Excel spreadsheet is really all you need to do. Some people like to use apps and things where they can, see their net worth at their fingertips. And I certainly don't, I think it's fine if people do that. But I think the biggest thing is get the facts, correct and put them down somewhere.
Perfect. Can you talk a little bit more about insurance? This is a hot topic, right? Because people don't think about this.
Mm-hmm.
So could you talk a little bit more about, how to cover yourself with real estate, get your personal liability, some of those things that we should be thinking about?
Sure. Yes. I would say that people who have, so there's two different ways you can go about tackling insurance. So you can go with what I would call the direct writers, right? The companies that advertise on television for homeowners, et cetera. And they're wonderful companies. But when you're working with a direct writer agent, when you're speaking with them, you're kind of speaking directly with the insurance company, if that makes sense.
Mm-hmm.
You also can go the route of an independent insurance broker where they can select from multiple companies. And that's not a fit for everyone, but as your life becomes more complex and perhaps you have more diverse insurance needs, you need maybe someone who's more of a holistic risk advisor to you, if that makes sense. And
Yes.
so that's a lot of times that's typically what I see is as my clients, are very successful, are worth several $1,000,000, they need to maybe make that jump. And it's not always a hard jump because they love their other insurance broker, it's insurance person. That's not the issue. That person, they're providing great service. It's just more it's two different kinds of structures or tiers, if you will, of insurance.
Does
Go ahead.
No, go ahead.
And I was just going to say, and of course, there's all different kinds, right? You got to insure the property if something burns down. You need to cover your liability. You might need to cover the contents. So there's just all different kinds of insurance you need to think about.
Got it. Do you think that, for instance, an umbrella policy or liability insurance can take the place of entity structuring?
No, I would say it lays over the top of that.
Okay.
It's more, that is the purpose of that. I mean, yes, the purpose of structuring here's what I would say. The purpose of structuring your entities properly is more to, when you have multiple properties, to insulate them from each other, right? Like if you own 3 pieces of real estate, you should have 3 separate LLCs with perhaps a holding LLC above it. But if something happens and there's legal action taken against you, they can go after your property, but they can go after, they also can, a good attorney is going to perhaps get past your LLC, go towards your personal assets, which is when the umbrella kicks in. So the question of how large of an umbrella do you need can be kind of a function of your net worth. Doesn't have to be equal to your net worth, but again, the higher that your net worth gets, you should have a higher umbrella. And I think just in general, real estate investors, you got tenants, you just get more parties involved in your financial life. And so, and I think real estate investors know that doesn't scare them, but it's just important to be insured properly.
Got it. So talk about sort of organization of all of this. I know for me, it's overwhelming. We talk about, it could just be a spreadsheet, but it always feels like it's more. So talk about sort of staying organized around all of this stuff.
Mm-hmm. Yeah. So once we get people organized on the front end, my team's next step is to build a process to keep it organized, right? And in situations where we're working with clients, we're typically taking that on, but sometimes we're training people how to do it. And I think the biggest thing is use a system. I mean, a spreadsheet I think works for doing a one-time inventory, but if you are, if you have got multiple units and you're collecting rents and you have expenses, you're going to want more of a accounting system, right? Like a QuickBooks or something like that. And it's really not that hard to use if you get it set up properly. And if you're doing when you're paying your bills, and if that's all if you're tracking all of that real time, when you're paying the bills, when you're receiving rents, and then you're just tracking them in your accounting system, then it's not going to be hard at the end of the year, right? Versus throwing it all in a box or something and dealing with it then. I've dealt with that. It's really not fun. Even I don't like doing that.
Got it.
And so, using online resources, linking things where you can link a software like QuickBooks directly with your bank account, directly with your credit cards. So you're not, typing in transactions. But the thing I would say so now it's tax time, right? And people are having to organize their information. If you had done it throughout the year, it would be way easier now. Also, if your CPA at this time of year is spending less time cleaning up, what you didn't do during the year, you can spend more time having, proactive conversations, right? I mean, February 2019 is not the time to talk about, what you could have done for 2018 taxes. Like that's over, right? Pretty much. So it's like start now to make a plan for this year and beyond on how you can get the most benefit out of, some really favorable tax benefits that are out there for real estate investors. It's one of the few industries that has, quite a few tax benefits inherent to it, and any real estate investor should fully understand those.
Yeah, so that's a great segue. Let's start talking about some of those.
Great. So I guess I'll kind of start with what I would say the more basic things that perhaps some of your listeners know, and kind of work our way up from there. We can decide how deeply we should dive. But I guess first and foremost, as I kind of mentioned, have a really good CPA. So if you don't have a good CPA right now, now is a perfect time to, find one, right? Ask your friends who are real estate investors, ask around, get good referrals. If you are investing in real estate, you should be working with a CPA who has other clients that are invested in real estate.
Okay, so first, I really like that. So first of all, I know a lot of real estate investors are like, oh, I've only got 3 properties. I can do it myself. Well, first of all, the laws are changing constantly.
Mm-hmm.
Every year, there's something different that happens. And your ability to stay up with all of the new laws will take you quite a lot of time. And you're probably not going to be as good at it as somebody that does this for a living.
Correct. Yes.
So first thing is buy expertise, right?
Mm-hmm.
And it's not that expensive. CPAs do not charge a lot of money for the level of expertise that they bring.
Mm-hmm.
It is seriously a deal.
Correct.
The second thing is that if you ever end up getting audited, you've got a professional supporting you that knows exactly what you've been doing, right? So when you are thinking about, should I get a professional or should I do this myself? You're not a pro at being a CPA.
Correct.
You're a pro at doing other things. So allow the CPA to be the expert that will make your life so much easier.
That's right.
So, and the second point is, if you're a real estate investor, get a CPA that understands real estate, because all CPAs are not made the same, right? They all have similar experience, but the more clients that they have in a particular industry, the more expertise they will have around that particular industry. So for me, I never work with a CPA that does not at least have a nice number of clients that are all in real estate. And I'll usually find my CPA by asking other real estate investors. So even if you don't know that many other real estate investors, go to a meetup. Ask online in forums or on Facebook. We have some online forums that are local where I can talk to people about real estate specific CPAs. That doesn't mean that they don't know everything else, but it also means that they're going to know the specifics about if you own 1 property, 5 properties, 100 properties, they're going to know a lot of the detail that there's no way that you could possibly know all of that stuff.
Mm-hmm. I couldn't have said it better myself. Wonderful advice, Monica. Yes, and I would say if sure, I get it. There's people they want to be reasonable with their dollars and what they're spending. And so that's fine. Then do a good job having good bookkeeping. So your CPA isn't, as I kind of mentioned, cleaning up what you didn't do. They can focus on their highest expertise. And so
Yes.
that's your role as a savvy real estate investor. Keep your numbers, your books and records organized. So your CPA can do what you pay them to do, which is, advise you on the things you really can't miss.
Exactly.
Those tax benefits that I've talked about, or that I will talk about, I guess.
Perfect.
And so if I may, I'll segue into just some basics. So you touched on this, Monica, briefly. The first thing you should do is make sure you have the right business entity structure. So you got your CPA on board, you did some great interviewing, you got a great CPA who knows real estate. You also should have, same discussion we just had about CPA, same thing with an attorney, right? And there's firms of all different sizes, so find the size firm that is right for you. But again, make sure you have an attorney that works with real estate. And you need to get that set up properly on the front end, right? Generally speaking, you shouldn't own real estate in a corporation. It just leads to some bad tax results. You should own it. Typically, people own real estate in an LLC. Sometimes there's a sole owner where it's what's called a single member LLC, and there's not a separate tax return for that LLC. Sometimes you may have business partners, and it's a partnership. Either way, it's an LLC structure, and it's got the most flexibility for real estate. I talked about if you own multiple properties, having separate LLCs. You might have a holding company over those multiple property LLCs. Some people have a management company. If they're doing a lot of active management of their properties, that might be yet a different entity. My point to all of this is getting it set up the first time, you should have your CPA and your attorney talking to each other. Like, have a meeting, all of you are in a room, versus you're talking to your CPA and then you're trying to collect what he or she says, and then you report to your attorney. It's going to be a really bad game of telephone, I guarantee it, right? And so when you get the professionals in the room, you don't need to do this all the time or even every year, although I think every year might be a good idea depending on how complex your portfolio is. This one time, you do need to make that investment in your business to do it right out of the gate. And there are tax reasons for that. There are legal reasons for that. Hence, get all the right professionals in the room together. And then your part of that as a real estate investor is to explain your goals, explain your objectives clearly, because that matters too, as to the advice they're going to give you about how you should structure this.
Got it. So one of the things that you mentioned is that, let's say, for instance, there's an action taken against you. And so you've got like a holding LLC, and then you've got individual LLCs for each of your properties, let's say, for instance, which is a structure that you mentioned. You also mentioned that a good lawyer could get through all of those entities. And that's why I get a little confused as to the benefit of having everything in entities. If people can get, here in California, we call them skeleton entities, where one person basically owns it all. And so lawyers are able to track right through them to get to you and your assets, right? So I have an umbrella policy, definitely, because I just figure they can come right through all the skeleton entities anyways to get to me. Could you speak to that a little bit more?
Sure. I think also, I think I say that because people need to be prepared for that possibility, but you also should do everything in your power to manage those entities in a way that they have a business purpose, right? Are you running them like a business? Are you doing, even if it's just you, are you doing annual resolutions about how you run the business? Do you have, a bank account for each of those underlying LLCs? Are you paying bills out of that bank account versus, only having a bank account for the holding company and then allocating down to the lower tier entities? So there are things you can do to, try to minimize that impact that could exist of, basically people looking through the whole thing for liability purposes. And again, your attorney can advise you on that. And you can, again, pay some amount to them annually to make sure that gets done as well, to protect yourself.
Got it.
So,
okay.
I know it all seems like a lot. I know how many advisors do I need and how much is this going to cost me, but doing something wrong, I'm sure we all can attest to a story we've heard about someone where if you don't do it right, it can, come back to be a bigger problem than it would have cost to just proactively deal with it in the beginning.
Right. I think that a lot of times an investor looks at this and goes, too much to think about. And it can be a hurdle to get through because you don't want to start investing until you've got everything, all your ducks lined up, right? I know I've talked to many of my listeners on the phone where they're like, well, I'm setting up my entities and I'm talking to my lawyer and I'm doing all of these things. And they're not investing until they've done that. Well, that's great and fine. However, what ends up happening is it ends up being an excuse to not actually get out there and start investing.
Good point. And that's a really good point. And that shouldn't be a limiting factor because it's not that difficult, especially if you're one person. Okay, so Monica, right? You were ready to just get out there and start. And so you bought a property and it was in your name. You can get that moved to an LLC. Where it gets more complicated is if, okay, well, now you also have a mortgage and, so if you're gonna take on debt, that's sometimes best done with the LLC up front. But you're right, it shouldn't be an excuse. There are ways that this can be figured out after the fact.
Right. And that was simply, and thank you so much for that, because everything can be rewound. Once you own the property, there's a lot of other things that you can do. You don't need to be set up with the perfect set of entities and know everything about tax law and entity structuring and all that stuff before you even get started. So don't allow it to be the thing that keeps you from taking action.
I think in general, that's a good theme for life. I mean, for myself, when I was starting my business 4 years ago, yes, I was clear about what I was offering, but did I have every possible client nuance about what services they might want and every menu of service that I might ever have to hand to someone drafted. No, I didn't. I just kind of got out there and said, this is what I have to offer. This is my expertise. And I see a lot of other business owners where they're paralyzed. They're like, well, I'm just going to create more content or whatever it is that they're going to do. And they don't just get out there and start. And then they spend so much time creating content or whatever they're going to bring out there. And then they find out it's the wrong thing.
Right.
They started to kind of start, be clear, but just modify as you go. It's a moldable experience. So
right. Thank you for that.
General life lesson. So then just general tax advice is, know what kind of deductions you're eligible for that are out there for a real estate investor. And there's the more basic deductions, right? Your travel, your meals and entertainment. I will say that entertainment has been, it's scrutinized a lot more by the IRS. So just, don't be thinking you can go wild and deduct a bunch of entertainment. Depreciation is the biggest tax. There's a lot of tax benefits and more sophisticated structures. But as far as basic tax benefits, depreciation, it's a non-cash tax expense, right? You don't have to spend money to get it. Well, you have to buy a property, okay? But you can, if you take on debt and all of that, it's not all out of your pocket. And so depreciation, is a deduction that lowers your taxable income from your real estate activity. And every kind of property has a depreciable life. So for residential real estate, it's 27 and a half years. For commercial real estate, it's 39 years. So you deduct that over the life of your property. And when you sell it, you do have to recapture that depreciation as ordinary income. So it is a timing difference, but there are, and I'll get into it later, but there are ways you can defer tax and do all kinds of different things when you're buying new properties. You also can do what's called a cost segregation study, where you can accelerate depreciation by saying, hey, this property isn't just building, it's, fiber cables for, that are 5, 7 or 15 year improvements. Or if you buy land and it's a parking lot and it's land improvements, those are, and that's the difference between depreciating or not depreciating if it's land. So that's just, just be aware of what your depreciation benefits are. It matters as far as your estimated tax payments you have to make. It matters as far as your cash return and what it's really costing you on an after-tax basis. So just know what you're eligible for.
So before we move on, there are going to be a lot of listeners that went, what? Mm-hmm. So let's dive a little bit deeper. What is the advantages of depreciation and how does that really kind of show up for people? Sure. Like, why would you want it to depreciate faster or slower or whatever?
So I see. So when you're, okay. So when I'll try to make it as simple as So if you buy a $100,000 property, and let's just say it has in the tax rules, it has a depreciable life of 10 years. That's not really a thing, but it makes the math easier. So that would be $10,000 a year in depreciation expense you can take on your tax return. So in my simple math, if you had $10,000 of income and you have $10,000 of depreciation, you have zero taxable income from your property. But you still have $10,000 of cash income, right? Because this $10,000 of depreciation is just a tax deduction. It's not something you had to write a check for $10,000 to get this deduction.
Right.
So what it's doing, and depreciation is for the real estate, the building, the stuff. It's not for the land, right? Because theoretically, when real estate appreciates, a lot of that appreciation is due to the land and the community or things just appreciating in value. And so depreciation as a tax expense is just kind of intended to line up economically with the fact that, your building depreciates. It just gets older over time. And so the, as far as when I said, if you have shorter lives, well, if let's just say there was a 1 year life of depreciation, or you could deduct that whole 100,000 or whatever, 100,000 in my example, that's more cash savings today in your pocket, if that makes sense. So the sooner you can take that depreciation expense, the sooner you're going to save taxes, and $1 saved today is better than $1 saved in 10 years, if that makes sense.
Yes, it does make sense. It does make sense.
It's
It
clear
does.
as mud to some extent. I get it.
Yeah, 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 yeah. The other thing is that there are implications when you sell of
hmm
having depreciated. Could you talk a little bit about what that looks like?
Yes. So when you sell, your property may have appreciated in value. So you bought the property for 100,000, you sell it for 200,000. You have a gain, a capital gain, let's say, of $100,000. However, let's say you took $50,000 of depreciation, right? So you're not only going to have your $100 gain on just what the property changed in value from the $100,000 you bought it for to $200,000, you're going to have $50,000 of ordinary income to the extent you took depreciation
Hmm.
during the time you owned that property. So depreciation, to my point about the time value of money, it's a timing difference because you do have to kind of match it up when you sell. You get an ordinary deduction when you take the depreciation. You have ordinary income when you sell the property. I won't get into it here, but there are strategies to, defer those kinds of gains when you are buying a new property, things like that. There's also estate planning things you can do. Maybe you don't sell your property because there's benefits of holding a property until death. Things, you got to step up in basis, things like that.
Got it. So this is why a lot of you who are listening have heard about 1031 exchanges,
hmm
is because that's one of the strategies she's talking about. And there are others, but that's the one that most of us hear about, is instead of paying taxes, you do a 1031 exchange, and your CPA can help you with sort of the parameters of that. There are timing issues, and there's a lot of other things around that.
hmm
Um, so that's one of the strategies. But here's one thing that I just want to really point out, that Angela said so eloquently, was that taking, you are getting the cash today to offset that depreciation. So what you're getting is real time, you're getting tax-free money that now you can use, right, either as your income or to invest in other properties. When you sell that property, let's say, even if you pay your ordinary income taxes on that, you've still had all those years for the benefit of that money to do something with it, right? So it's not like the government is out to get you when you sell.
No.
And this is the thing that people get so concerned about. Oh my gosh, I'm going to have to pay taxes on this money. Yes, but you got the free use of that money for that many years that you held that property. So yes, certainly you want to figure out ways to keep more of your money, take advantage of the way that the tax laws are structured, which actually can benefit you in a huge way. But if you do end up having to pay taxes, don't feel like, oh my gosh, I'm losing money. I'm giving so much to the government, because
hmm
you've gotten the benefit of that money through all of those years, right?
Correct. And also make the right decision for your investment. You might hear people say, like, let's say they were going to sell something after 6 months and they're like, well, I want to hold on for long-term capital gains after 12 months. Well, I don't know, 6 months from now, your property might, I mean, this is less common in real estate, more common in equities, but it's like, don't let the tax tail wag the dog here, right? Make the decision that is the right economic decision. Know what your tax options are, but you know, don't let taxes be the only thing that drive your decisions.
That's right. It's a piece of the puzzle. It's not the
Mhm.
entire puzzle.
That's right.
Yeah. Okay, perfect. So I interrupted you. Keep going.
I would just tell, and I'm not going to go into any level of detail here, but you mentioned 1031 or like kind exchanges are called. If anyone is at all exploring that, I would have them also ask their CPA about opportunity zones. It's a new way to defer gains. I won't get into it here, but it's very new, and people should at least be asking their CPA about the details. It can be similar to the result of a like kind exchange, but it's very different.
What's it called?
It's called an opportunity zone investment. If you're taking your gain and investing it in opportunity zone property, there are
Interesting.
tax deferral and other benefits. It's intended to stimulate the economy in areas that have been identified as distressed and would benefit from long-term investment.
Perfect. Okay, lovely.
Okay. Um, So let's see. Something else you should be talking to your CPA about under the new the new Tax Cuts and Jobs Act. You may have heard of this qualified business deduction. It's a deduction of 20% of your net income from a trade or business. And so you should be talking to your CPA about, does real estate qualify as a trade or business? Again, to my first point about how you structure it, how you handle it, it's, the IRS hasn't totally weighed in on this, but generally people are thinking that you can get this deduction on your real estate net income. And I won't go into, there's a lot of complexity around that as well, and who can take it and what income thresholds, all kinds of different things. But again, qualified business deduction, Section 199A, 20% deduction. Those are the things you should be bringing up.
And the one thing that I want to just say about that, just getting a real estate license does not get you this. There are a lot more rules around it than just that. Because I know a lot of my callers will say, oh, well, I'm getting my license so I can take this extra deduction. Not necessarily. It's a step, and not even necessarily the most appropriate step. So talk to your CPA about what your options are for that.
Yes. And then I don't want to, again, this is another like depreciation. This next topic is about as clear as mud as well, but there's passive income and there's non-passive income. Real estate by its nature is passive by definition. And so to the extent you have a loss from your real estate activity, and people will be like, well, why would I have a loss? That's really bad. With these really good depreciation deductions, it's very likely you'll have no income, no taxable income, cash income, yes, or a taxable loss. You can only deduct that passive loss if you have one or two things. Number one, you have income below a certain level, below 150,000 of AGI, you can deduct 25,000 of that loss. Otherwise, you have to have passive income. And so if you have multiple properties and some have taxable income and some don't, they can offset each other. Okay. You can, depending on the significance of your real estate activity, make it non-passive. You can materially participate, have 500 hours or more per year per property. You can make a grouping election to aggregate all of your properties for that 500 hours. We won't get into that. And then you also can make a real estate professional election as well. And there's additional hours, 750 hours a year, more than 50% of your services you provide are in the real estate business, things like that. That's a one-time election. All of these things are very fact specific. Again, more backup for our argument that you need a great CPA who understands your facts. These two items are very, very fact specific.
Got it.
And some of the rules around losses and how you can deduct them have changed with the new tax law as well. And I'm a CPA. I haven't practiced in public accounting for a while. So even I, as I'm advising my clients, I'm their family CFO. I'm quarterbacking their whole financial experience. I'm going to their CPA too. Now I know what to bring up. I know what to ask. And so that's what I would say to people is like, you need to kind of be your own personal CFO, until you're successful and wealthy enough to hire your own, right?
Right.
Hire someone to do it for you. So my point is know enough about these things so you can kind of raise your hand and say to your CPA, like, do I qualify for this? Or I've heard about this. They should be bringing it up, but it's also your job to, make sure you're asking the right questions.
Okay.
Let's see. A kind of an easy one that maybe people don't know about. I've heard you say on your podcast, Monica, that a lot of people's first investment in real estate is their home, right? Obviously,
right.
And that's kind of what gets them into this. And the capital gain exclusion for selling your primary residence still exists, and it's $250,000 gain exclusion for a single person and $500,000 for a married couple. So that's just something to think about. And the rule for that is it has to have been your primary residence for 2 out of the last 5 years. You also can, if you really wanted to, you could, if you started out with a property as a rental property and then you move into it for 2 years, you can make it a primary residence, get this exclusion. Now, there are rules about how many times you can do that. I don't believe you can do it every 2 years. But it's just an important exclusion to know that's out there.
Right. And I've taken advantage of that.
Mm-hmm.
So,
right.
Yeah.
Well, it's, if people have in Minnesota, we call it a cabin, if other people call it cottages, but people do that all the time, right? They sell their primary residence, their cabin they've had for recreation for years. They move into it, make it their primary residence. 5 years later, sell it. They can exclude that gain as well. It can be a great tool for the right people.
Right.
And then I guess the only other, I'll touch on conservation easements. That's another way to get a larger deduction to save on taxes. They're very complex and you need to pick the right one. And then also when you're in business, whether you're in real estate or otherwise, you can hire your spouse, hire your kids to, do work in your business. So, I think the IRS might scoff at you hiring like a 6-year-old,
Mm-hmm.
But, and the kids are 11, 12, whatever, there's reasonable things they can do and you can pay them, whatever, 5, 10, something $1,000. And then you can do 2 things. You can contribute to a Roth IRA for your kids, which if you do that for someone who's 12, 13, 14, 15, that's amazing from a long-term investment perspective. Or you could use that money, which now you've gotten a deduction for it, to pay, their private school tuition or something like that. So you're effectively turning a not otherwise deductible expense into a deductible expense. Now, your kid needs to legitimately be doing something, if scrutinized upon audit, as you mentioned, you need to be able to say, yes, my kid was filing or doing shredding or, things you would otherwise have to pay someone to do, right? Or do yourself. So those are kind of I'm kind of glossing over the surface, but those are some things that people should be thinking about from a tax perspective.
Perfect. So that was a lot of information. Thank you for that.
Mm-hmm.
We are going to be doing a deeper dive in the extra portion of this show. So for those of you that are subscribed to Extra, you're going to get more information. But for those people that are going to be signing off after this first part of the show, what is just some key advice that you would give them to take with them today to sort of help them to relax a little bit about this whole tax issue?
I think, if you want to do one thing today to make yourself less nervous about all the things I just said that might have made you freak out a little bit, is start asking around to get yourself a good CPA, right? Someone you're comfortable with, someone who has experience with real estate, someone that you can have, feel like you can dialogue with and ask them the quote unquote dumb question, although there's never a dumb question. I actually think the more questions you ask, the more you learn, the more it shows what you really do know. So that's what I would say. Get a good CPA. If you don't have advisors, start working on that today.
Great. And don't be intimidated by that. I know so many people who are like, I don't want to talk to a banker. I don't want to talk to the CPA. I feel so stupid. But the thing is that find someone that you can talk to. Find that CPA that will ask your questions, that will answer your questions, that will make you feel comfortable, that's open to the conversation. If they're not, you just have to find the next person.
That's right.
Don't continue to work with someone who makes you uncomfortable.
Right. And not all CPAs or other professionals, they don't all have the same personality, right?
That's right.
Some are more, they want to be just putting the numbers on the forms. They don't necessarily want to be talking to clients. Some of them want to be talking to clients all the time about, they love real estate. They love all these different things and teaching people. So find someone like that who really wants to, teach you this business, at least from the tax side.
That's right. Great. Okay, cool. So, Angela, how can people get in touch with you?
Yeah, so they can go to my website. It's simplify-wealth.com. And my email address is on there. And if they email me, I will send them, I mentioned, knowing what you own. I'll send them the checklist that I go through with my clients of all the things you need to identify and know what they are and get them documented.
Perfect. Thank you for that. And in order to get that, there is going to be Angela's email address in the show notes. But for those of you who are listening, it's Angela, which is Angela, at simplify-wealth.com. So, and you can go there to get her checklist. So awesome. So, Angela, are you ready for our 3 rapid fire questions?
Sure.
Okay, the first one is, give us one super tip on getting started in real estate investing.
Sure. So I would say educate yourself. Just get out there, start asking questions, listen to podcasts like Monica's, meet other professionals. I'm sure you can attest, Monica. They love talking real estate.
They do.
Right?
Oh my goodness.
Like
Yes.
their absolute passion. So again, these people aren't scary, right? So just you got to kind of get yourself out there and start getting familiar with the industry. But just start somewhere. Start wherever you're comfortable.
Awesome. And then what's the strategy on being successful in real estate investing?
I think it's continuous communication. Again, I think this is just also just a life strategy, but I firmly believe that proactive communication is a key success factor. So you need to be communicating with your team, your professional advisors, people in your network, whether it's about deal flow or taxes, or just, if they're your support staff, what needs to be done today. The more you can just proactively communicate with people, the more you're going to be productive and get the right things done and achieve your goals.
Perfect. And what would you say is one daily practice, Angela, that you use that contributes to your personal success?
Sure. So every night I sit down and I make my list of to-dos I have like my really long to-do list that kind of sits over here, but I write, maybe the 4 or 5 key things that I'm going to do in priority order. And I do that for 2 reasons, because then when I wake up in the morning, you kind of feel scattered. You got to reorient yourself. You look at the list like, oh, look, there's 5 things. It's just laid out so nicely for me. And also I'm achievement oriented. And so I very much enjoy checking things off the list. It makes me feel like I, have accomplished something for the day.
Awesome. Yay. I do that too. I love that. And for me, it's mostly because I wake up in the morning and I'm like, oh, where do I start? And
Correct.
That gives me my place to start. So That's fantastic. Well, Angela, this has been very informative. Thank you so much for all that you've shared so far.
You're welcome. Thank you so much for having me. This has been really fun.
Yeah, thanks. And we are going to continue the conversation. So those of you who are subscribed to Extra, please stay tuned because Angela's got more for us. For those of you who are not subscribed but would like to, you can do that at realestateinvestingforwomenextra.com and just subscribe there. And for those of you that are leaving us now, thank you so much for joining Angela and I for this portion of the show. I look forward to seeing you on the next show. And until then, remember, goals without action are just dreams. So get out there, take action, and create the life your heart most deeply desires. I'll see you next time. I hope you enjoyed today's show. If you'd like to download my favorite investing strategy, just go to blissfulinvestor.com. See you next time.